Well, good morning, good morning, good morning, and welcome to another episode of Money Matters. My name is Nev. Today is Thursday, January 7th, I believe. And on Thursdays, we do real estate. And of course, we're going to be taking a look at what's going on in the world of real estate and real estate money. So, of course, we're going to be taking a look at the mortgage rates and why they're climbing and what we can expect to come short term. Long term, and it's anybody's guess, but at least short term, we can take a look at what might be happening with mortgage rates. And if you were on the verge of like, should I refi, should I not, should I buy, should I not, well, perhaps today's episode is going to help you to make that decision. Of course, I can't give you that advice. You're going to have to make that decision on your own. But what I can do is give you the news and information so that you can make an educated decision. So we're going to be taking a look into that. We're also going to be taking a look into the top markets and industries within real estate that folks are basically clamoring in, some of the potentially best performing markets in United States when it comes to real estate for 2021. This is going to be a very exciting show. We're going to be covering a lot of things, and we're going to be moving quite quickly, so please do pay attention. If you're brand new and you haven't subscribed quite yet, do subscribe to the channel, do hit notifications, make sure you hit all notifications so you get notified every time we go live, which is just about every single morning at 7 a.m. And what you also want to do is make sure you hit the like button. If you could do me a huge favor, if there's a heart button, if there's a button, some sort of method to say, hey, I'm a live human over here interacting with this video. Or if you are listening on one of the podcasting services, hey, do me a huge favor, do subscribe to it as well, and do provide me with some feedback. All right, y'all, let's do this. And good morning. All right, so let's get started. Before we go into anything real estate, you know how passionate I am about real estate as well as crypto, and it would break my little heart if we didn't at least address what the hey happened over the last 24 hours in the crypto market. So I'm going to do that really quickly, and then I promise we get into real estate stuff. So as you can see, the super exciting piece is that we did officially break over $1 trillion in the global crypto market space. We did talk about that yesterday. It's probably going to happen. We did also hit some brand new highs when it comes to Bitcoin. 37,292 and 46 cents is where we currently stand. It did pump 6.7% in 24-hour period, up almost 30%. Okay, 29.3, but let's say call it 30% in 7 days. Ethereum hasn't done as hotly over the last 24 hours. It's currently trading at $1,193.38, up only 3.8%, but it did pump 58.5%, almost 60%, y'all, in the last week. This is absolutely amazing, and it's pretty freaking awesome. We did have some absolutely insane gains yesterday. Holy mackerel. If you are in the market, you probably have made a lot of money. So congrats on that. Nano is winning in the 24-hour period, pumping 122% exactly. Rift token up 75.3, Verge 48%, Status 38.4, XRP 38.3, Yearn.finance 32.1, Terra 30, Maker 27, Matic 25. I mean, you can see this insane gains, y'all. On the losing ends of things, honestly, not a whole lot of losers. Few here and there, very small single digits. Biggest one is empty set dollar at negative 14.3%. And then after that, we get into Synthetics Network token at negative 7.5, Sushi negative 6, Theta Network negative 5.7. And I mean, as you can see, not a whole lot of losers, a lot of gainers, a lot of mad money that has been made. All right, so that was it. That was it for crypto. I promise we're going to do more crypto the rest of the days, and we're going to come back to it. Now it's time to get into real estate because this is a really important marketplace, and I believe that it does pose a lot of potential. And I know that people that when they do different channels, they were like, real estate or nothing, gold or nothing, crypto or nothing. And I'm like, folks, let's not fight. If there's a way to make money, why not make with it? I am investment agnostic. If it can make money and preserve my wealth and protect me and provide me with income and growth, hey, I'm interested. I want to know. I want to participate. So the first thing we're going to take a look into is a chart. And you might be saying, wait a minute, Nev, you just said we're going to be talking about real estate. Why are we looking at a freaking chart? Well, this is a treasury yield 10-year. And right now what we're looking at where the yield has been. Now, why do we look at the 10-year treasury? Well, because it affects mortgage rates. So mortgage rates basically follow what's going on in the treasury yield and adjust accordingly. So what did we see happen? Basically, this is, obviously on the 5th. Here is the 6th. Today's the 7th. We don't have information yet because we're so early, so we don't know where it's going to go. But you notice something very interesting, that we gapped up into 1% and over. Now, that's not a huge return if you are in bond markets, right? But it is a huge gap, as you can see, because where have we been thus far? Here's where we've been. We've been well below 1% over here. And if we zoom out even further, okay, hold on. It's not liking this stuff. Let me see if I can change this. There we go. If we zoom out even further, you can see that we were down at like 0.5%, in August. Since then, we have been climbing steadily on up. And now, when you take a look at the last, month and stuff, look at this puppy. It actually just jumped up. So what does that actually mean? Well, mortgage rates are spiking. Yes, there we go. So they have surged and investors expect more government spending. As that happens, that oftentimes requires the issuance of more treasury debt, which pushes yields upwards. So we could potentially see that the yields are going to go up. The bond prices are going to go down. And that also means that the mortgage rates are going to go up. The interest on treasury bonds has jumped and mortgage rates have followed suit. The rates on a 30-year fixed mortgage jumped to an average of 2.85% on Wednesday from 2.78 a day earlier. Now, again, not a huge jump per se, but in real estate, we are dealing with tens of thousands, hundreds of thousands, sometimes even millions or tens of millions of dollars. And any small movement actually makes a big difference when it comes to paying off that debt, right? So you got to pay attention to that stuff and be very cognizant about what's going on, which is why we cover it every time we talk about real estate. But the rates tend to follow the yield on the 10-year treasury note, which shot above 1% on Wednesday for the first time since March. So since March, we've been going kind of down. Now we're starting to turn that tide and start going on up, which is potentially not that good for climbing prices of real estate, and it could have a potential impact when we talk about the prices of real estate and where they're going to go. So far, the prices have been going, really high up like crazy because A, we have low supply, B, we had high demand, and the mortgages were low and the rates were dropping. Now it's going to be a bit more interesting because things are starting to shift, and they're shifting in a way that while supply is still on the lower end, we're also in winter months, so the demand is probably going to be a bit lower for the next few months because it typically is during this time of the season. But I think the interesting piece is for the home prices. As we see the rates start to go up, will the prices continue to climb? Will they reach the peak and start coming back down? That's the piece that we're going to have to watch over the upcoming weeks and months to prepare for that. Anytime a party has a full control, which is what it seems like we're going to have for this 2021 session starting up in about 2 weeks, it's easier for the government to spend money and pass all kinds of different bills. So the result is more treasury debt, and the level of treasury debt is a key input for interest rates in general. The sharp uptick in bond yields is likely to keep pushing mortgage rates higher in the coming days, but the broader path forward for mortgage rates remains less certain and largely depending on the economy's ability to continue to improve. So that's one of the things that you definitely want to look for, right? If you are thinking of potentially buying or refinancing and that kind of stuff. Now, you do know that I like to play around with this chart over here, and I noticed something very interesting that I wanted to share with you. So we are looking over here at the chart from Zillow mortgages and mortgage rates, and we're looking at the purchase for credit rating of less than 680, putting less than 5% down. We're looking at the 1 month span, and kind of we've been going mostly sideways when it comes to the 30-year yield, or the 30-year rate, sorry. And you will notice something very interesting. While we did have an uptick right here on the 30-year that is above 3% right now, the 15-year it actually went down to almost like 2.3, 2.32. So it actually dropped, interestingly enough. When we look at the refinance, of course, it dropped down and it's staying on the flat stuff, still well below 3% on the 30-year fixed, and we are just slightly above 1.95% on a 15-year. So we're starting to see some changes with how the lenders are seeing the market and where they're seeing. So you can see that they are also looking and saying, oh, I don't know what is going on, what is happening. We should be paying attention to that. So definitely something for you to think about, consider. You also have to understand that the new fee, the extra fee that is coming from the housing authority, that is a real thing now. So that is going to make the prices of homes also much, much higher. Now, it's time to take a look at the real estate that everybody is clamoring and saying, wow, we got to get into this stuff. And while residential is still pretty darn hot and many people are looking into it, this particular one is actually in retail, believe it or not. And you won't believe it, but it's actually grocery stores. That's right, grocery stores are the new hot ticket item for real estate investors. Well, as you start pausing and thinking about it, I'm sure you can come up with an answer as to why. So grocery stores are becoming the dream properties coveted by hard to price away from their owners. Food shops have been among the few retailers allowed to trade throughout the pandemic, and business has been strong. Many of them have been increasing their returns, right? Their revenue has been going up quite a bit between people buying more, between people, buying more cleaning supplies, toilet paper and that kind of stuff. So the strength has now fed through into the real estate market, where the superstores are in demand and landlords haven't struggled to collect the rents from grocers as they have from other retailers. So they're receiving on average 100% of the rents owned, which is amazing. And that's really a stark difference compared to some of the other things like shopping malls, where we're seeing the struggle to actually collect the rent, and they're getting anywhere between like 65 to 78, 79%, maybe 80 to 82%. So this is a very big difference. And of course, if you're an investor or the owner, you would rather collect 100% of the income than 70 or 79%. So that's a really big difference. And so that's the reason why now there's a big growing competition to buy grocery stores. And of course, the prices are starting to go on up. So this is going to be an interesting sector to play around if you are considering going into the commercial space, even if you are in the REITs, right? If you're in the paper market of the real estate. So that's one of the things that you want to kind of consider and say, does this make sense? Now, this could potentially get super heated as we're getting more news of like Macy's is shutting down stores, Bed Bath & Beyond just announced shutting like 40 some stores. So we're getting some of that on one end, right? And then we're getting on the other end that, places like, retailers like grocery stores and pharmacies are doing extremely well. So now when we talk about the commercial real estate space and retail, we got to get very, very specific of what we're talking about. Are we talking about as a whole, or do we have to then segment it as well? Just like when we talk about real estate and residential real estate, a lot of times when we cover these national news, we're covering national news and talking globally. But of course, that's very different, because when we talk globally, we're missing some of the pockets. So globally, real estate could be going up, say, 7%, but in one market, it actually could be going down 40%, right? So it's very localized and it's very specific. And even within that market, that is not performing really well, for example, like San Francisco, let's pick on it because it hasn't been doing all that hot. There's certain sectors that are not performing really well, like higher end condos, for example, have been going down in price, but affordable, smaller apartment communities and affordable communities within the area has been doing really, really well. So you have to really segment the market and be very, very specific about what you're talking about when it comes to talking about real estate. Now, here we go. We're going to talk about also another one of those things that we've been covering in the past, and that is the real estate tech that has been developing and growing. And I think it's coming and it's here to stay. And more and more people are going to enter the market from different perspectives. And this has to do with the tech-driven buying opportunities and some of the plays within the stock market, the REITs, as well as for you as the real estate investor and potentially buyer and seller of the whole thing, of how this plays effect for you. So Opendoor is spiking as folks are warming up to iBuying. So the arrival of the tech-driven real estate company Opendoor Technologies in the open market is casting new light on the property tech sector, specifically the iBuyer market. Wedbush Analyst is picking up the coverage of Opendoor with an outperform rating and $31 price target on Wednesday. He's also very bullish on Zillow, on Redfin, and he believes that all of these areas are going to go on up. Opendoor shares had spiked 8.1%, and it's going to be a very interesting piece. Now, you might know that Opendoor became public late last year. So I want to say they went out November, something like that. We covered it on the show, and they basically went public with the merger with the special purpose acquisition company, or SPAC, right, which has been sponsored by the Silicon Valley investor Chamath Palihapitiya. So as you know, Chamath has been very bullish and big investor in many different sectors. A lot of it has to do with the cryptos and it has to do with tech. So it's no surprise that he is part of this deal. Opendoor has turned into a leading tech disruptor with residential real estate. And this is according to this particular analyst. Now, iBuying is another thing that the Zillow actually has jumped into it. I believe Redfin is starting to jump into it. And we're seeing a lot of movements within this section. The iBuyer model, as you may or may not know, offers significant advantage to both home sellers and buyers by simplifying transactions that are ordinarily high complex. And of course, the opportunity is beyond simple arbitrage, where the iBuyer basically buys it directly from the seller. They hold on to it. They allow the stuff and allow people to basically self-tour, and then it sells it to them, and of course it sells a profit. So we did cover that in depth. I'm not gonna spend time doing that over here. He is also bullish on Zillow as well, which also has moved into the space. Now, here is the quote coming from him. We expect real estate technology adoption will accelerate with an opportunity to transform the industry. We're moving from an era of technology adoption in residential real estate being informational in nature, like looking for homes to Zillow, to transactional, such as buying homes and getting a mortgage on Zillow. Zillow can benefit both as an iBuyer and via its web portal business. So this is a very interesting thing. And I do agree. I actually do believe that the real estate technology adoption is going to get even bigger and even stronger. And that's why I'm actually particularly working on those pieces. And fingers crossed, if all goes well, we should be launching in Q1 of 2021. I am so giddy, I could actually go and start running in circles. And sometimes I do. I just turn the camera off. Okay, with the tech-enabled brokerage attached to its iBuyer offering, as well as strong online portal and mortgage business, Redfin can also more easily recognize synergies and attach key ancillary revenue streams that are so critical to ultimate long-term success for its model. So that's what makes the Redfin potentially very, very, very bullish space. Speaking of some of the tech-driven real estate stuff, we do also have some information about the company called Knock. So Knock has launched a home swap product in Jacksonville, Florida, which is the 6th location in the Sunshine State and 15th in the U.S. Home swap is offered exclusively through local real estate professionals who have been trained as Knock certified agents. And in these particular markets, home swap will be offered through Keller Williams Atlantic Partners. So if you're interested in participating in that and you're in Florida, hey, look for these folks. Again, they're not paying me. I'm just saying what they have. We're going to explain what it all is, so stay tuned. Given the high amount of multiple offer situation we're currently seeing, it's hard for many buyers to be competitive while also trying to sell their home at the same time. The home swap program is a huge advantage for customers in these situations. Via home swap, customers can take ownership of their new home while prepping and preparing their old house to sell. Knock provides consumers with a mortgage on the new home, an interest-free bridge loan to cover the down payment, coverage of mortgage payments on the old house, and up to $25,000 for home prep and repairs for the old house. So basically, if you're in the market and you want to go in and, buy a new place, but you have a place and you're like, I got to sell this. And now you're like, I don't know what's going on. Well, you can work with these folks and work with Home Swap, where you can find a place, go into it. They will provide you a loan. They will provide you some money to get it prepped. You're able to move, vacate the thing. The property can be on the listed, and then once it sells, then you actually pay off all of the loans and go right back into the normal mortgage. So I think this is really huge for the market and for the real estate as a whole, because what it does have and what it does provide us with is the ability to actually go in and get some of these sellers that have been wanting to sell but are sort of on the fence. So this could potentially provide with more properties on sale. And so when I look at that, when I read that news, and when I read the news that the mortgage rates are ticking on up, and I see supply potentially starting to pick up, I could very easily discern and conclude that more likely than not, we could see some slowing of the price appreciation and potentially some reduction in prices, which is not necessarily a bad thing. We don't want to get into the bubble territory. We don't want to get into this crazy, prices are going up 40, 50, crypto kind of appreciations. Like, that's not supposed to happen in real estate. And personally, I think it's healthy for us to take a little bit of a step back. Now, I know that's sacrilege for many people out there that I am saying that stuff, because real estate tends to sort of lead the economy, so to speak, because vast majority of individuals out there, most of their wealth is actually in real estate, not in stocks. Why? Because, well, most people have homes, and so their money is tied up in that equity right there. And so that's why it's a very important market. The second reason, or the third reason, so we have potentially higher supply that is going to come in from the current ownership. We have builders, which I haven't talked about, but builders are actually coming in and delivering more. So there's going to be more supply from the new homes. We are having mortgage rates that are starting to come up. So that's going to have to push the prices to start kind of coming down because of the affordability piece. Then we also have the lumber. So the lumber is the leading indicator for mortgages and for housing. So lumber prices have started to come down. Well, with the lower prices of lumber, that means that we can actually lower the price of the new homes coming in. And we're also seeing lower income levels. So lower income, lower lumber, right? More supply, folks, do the math, right? So I do think that over the upcoming months we could actually see a bit of a cooling down. I could be grossly wrong. I mean, I don't know that I or anybody else expected that people are going to go like bananas for real estate in during the pandemic. I don't think anybody saw that. I also don't think I saw that stock market is going to go bananas during the pandemic, but there we were. That happened. So we'll see how it all plays out. I'm just sort of thinking out loud globally of what 2021 may look like for real estate with some of this new information that is coming our way. Now, one of the other pieces that I think is also very interesting is that Amazon is pledging to actually put in money for affordable housing within their hubs. So what's going on? Well, Amazon said on Wednesday, so that's yesterday, that is launching a $2 billion housing equity fund to preserve and create over 20,000 affordable housing units in Washington State, Puget Sound region, Arlington, Virginia, and Nashville. 3 areas where a company has or expects to have at least 5,000 employees each in the coming years. The fund aims to preserve existing housing and create inclusive housing development through below market loans and grant to housing partners, traditional and non-traditional public agencies, and minority-led organizations. So this is actually really, really huge and really good, and it's going to push, potentially provide the ability for the affordable homes to kind of come into the place. Now, they're going to be providing below market capital in the forms of loans, lines of credits, and grants. And so this is going to be really good for folks that absolutely need it. We'll see how it's all going to play out, but I think that these particular sections, these particular towns are potentially posed to then grow and develop. Now, typically things end up starting as affordable, and as more folks go in, competition kicks in. So affordability then becomes sort of this questionable word. In each of these areas, Amazon is targeting households making between 30 to 80% of the area's median income. So that's kind of what the guideline is going to be. So if you're making less money, you potentially could be getting some additional funds that Amazon is actually putting in. So that's kind of a nice and lovely piece. And I think as an investor, it might be a really good idea for, if you are in these markets, this could be very, very bullish and beneficial to you. So something to always pay attention to, because in a real estate, you want to pay attention to many different areas, not just the mortgage and the particular home itself. So you got to be sort of paying attention to everything: copper, lumber, labor, everything else, jobs, schools, economy as a whole. So like everything has to play a part of it. And to finish today's episode, here we go. Some of the hottest top markets for 2021. Where should you consider putting your money in, or at least monitoring for the 2021? This is coming from Forbes and Realtor.com. According to Realtor.com, report tech hubs and state capitals will lead the pack for home appreciation and sales growth. And of course, the top 10 out of 100 markets include, in order, Sacramento, San Jose, Charlotte, Boise, Seattle, Phoenix, Harrisburg, Oxnard, Denver, and Riverside. So that's where they are going into. And of course, the Sacramento, San Jose, and Charlotte are the top 3. Boise is in top 4. So you can see a lot of places in California, a lot of places on the west side of the house. So that's going to be an interesting piece. And we do have one hub on the East Coast, Charlotte, North Carolina. And Charlotte, North Carolina has been a place where people are going into. Really nice weather, really good schools, really affordable housing. So people are going there. And we're also seeing an interesting fact about Charlotte is we're also seeing a lot of crypto companies actually being in Charlotte, shockingly enough. Home prices across these top 10 markets are forecasted to increase by 6.9% and sales by 13.1% year over year, whereas national numbers are going to be 5.7 price appreciation and sale growth of 7%. Now, again, 5.7% price appreciation is nothing to sneeze at. Again, when you compare it to the crypto, you're like, nothing, right? I get it, but there's other benefits to real estate. So you got to look at it globally, y'all, not just locally, okay? So this is a really high appreciation anyways, and of course, they are poised to grow potentially a bit higher and faster. Sacramento ranks number 1 for 2021 with a median home price of $554,000. Home prices are expected to increase by 7.4%, while sales activity will increase 17.2%. So that could be an interesting play. San Jose, they are, of course, their average is like 1.2 million, right? So it's, sorry, not 1.2 million. 1.5 million. So, it's a bit more expensive, but of course, people are going into it anyways. Number 3 ranking is Charlotte, North Carolina. A lot of new construction is happening over there. Median home prices at $368,819, and sales activity is expected to grow by 13.8%. So there you go. If you are curious about, hey, where is the hot market that I can potentially play in 2021? Well, maybe these are the hubs. Of course, we're going to be covering additional things as they're developing, as they're growing, and as we launch with our Real Tech. Of course, I'm going to be sharing that proudly, very excitedly, and stay tuned for all of that stuff. So, hey, if you have enjoyed any of this stuff, do me a huge favor, smash the like, smash the subscribe, smash notifications, forward it on to the people, and I will see you tomorrow. And as always, until then, stay forever money blessed, and do remember, you are only one deal away.